it is an alternate place to store your capital that builds up, that capital pool builds up over time so that you have alternate financing solutions. And as a small business owner with irregular cash flows, hot months, hot years, followed by maybe some slow months, maybe some very low revenue months, right? And so the need for financing, while everybody has a need for financing throughout their life, the need for financing by a small business owner is kind of amplified, I think, especially in the beginning stages when cash flows are not regular and are not as predictable. And so having an alternate source of financing is critical.
You're listening to the Traffic Handler Podcast. We're about getting new customers, making more sales, and growing your e-commerce retail business. I'm your host, Amy Biddle. My guest today is Brandon Jenkins of Tier 1 Life Insurance. Brandon has been my life insurance guy for a few years now. And so what is the connection between life insurance and e-commerce? Well, there are going to be times when you have a lot of money, and then there are going to be other times when you don't have a lot of money, because it's the nature of business to go up and down. It's the nature of e-commerce specifically. There are fat months and there are skinny months. So I wanted to have Brandon come on and talk about the types of policies that he writes that act as investment vehicles, not just death benefit like you think of with insurance. So please give Brandon a listen. It's a quick and easy episode. And if what we're talking about is interesting to you, there's no kickback to me. I'm bringing this information because you're a business owner. And as business owners, we need to have different approaches to the financing. So enjoy the show today. Very informative. All right. So we are here today with Brandon Jenkins of Tier 1 Life Insurance. And Brandon isn't just a life insurance guy. He's a friend. And I'm excited to bring him on the show today. And what the heck does life insurance have to do with e-commerce? So I'm going to let Brandon explain all the details, but this is about how to allocate your finances when you have extra cash. Or I'll let Brandon take it over because he's got all the details. And this is a method of managing cash in your life and business that is off the charts cool. So Brandon, welcome. I am so excited to have you here.
Thanks, Amy. It's a pleasure being here. I really appreciate you inviting me on.
Absolutely.
Yeah, you started to hit the nail on the head there. I think that your audience is composed of a lot of small business owners.
Yes.
And you mentioned that I use the life insurance and I help clients implement the life insurance as kind of a cash flow management strategy. Some people know it as infinite banking. Some people know it as bank on yourself. But really what it is it is an alternate place to store your capital that builds up, that capital pool builds up over time so that you have alternate financing solutions. And as a small business owner with irregular cash flows, hot months, hot years, followed by maybe some slow months, maybe some very low revenue months, right? And so the need for financing, while everybody has a need for financing throughout their life, the need for financing by a small business owner is kind of amplified, I think, especially in the beginning stages when cash flows are not regular and are not as predictable. And so having an alternate source of financing is critical.
Absolutely. I mean, I've been working with you for, since 2019. And we've purchased a couple of policies and we've had to use them a couple of times, and I've always been glad it's there. For anybody, so let's dig a little deeper into what infinite banking or bank on yourself, because those are the two things. The two, people in the industry have written the books and described, kind of what this is all about. but you're the guy who puts it into motion. So can you tell us a story or like a case study of an example of how somebody might use this?
Yeah, absolutely. So I tend to work a lot with small business owners,
Mhm.
with real estate investors, and with people who maybe have been doing the typical, 401k maxing out Roth IRAs, and dollar cost averaging into the stock market. But most of the time, the clients that come to me and asking for help, they realize that, wait, there's a flaw here. I'm putting away all this money, but it's going into vehicles where I don't have a lot of control. I don't have access to the capital, and there are no guarantees that it's going to be there when I need it.
That's right.
Historically, if you put money into the S&P 500 over 40 years, right? You've heard it before. You put money in, 40 years later, you get that historical rate of return, and hopefully you have a big pile of money sitting there waiting for you. The problem is that life happens in between.
Yep.
And life and the markets are volatile. And throughout your life, you're going to want to tap into your capital in order to make the investments you want, start the businesses that you want to start, contribute to the causes you want to contribute to. And so therefore you need a strategy that allows you to do that. I call it a resilient strategy, because by implementing this tool into your strategy, it allows you to bounce back during hard times.
Yes.
It allows you to keep going during recessions and market corrections, and in those months when your revenue's not there.
Yeah.
And so the first step that I would tell anyone, whether you're working with me or not, is to get clear on your core principles. What is most important to you, and what would you want a financial strategy to do for you? That's the first step. And that's where I would start.
Perfect. Absolutely. So let's say, like a lot of the people who are listening to you right now, they have a business. E-commerce, any retail has fat months and skinny months, and times when you have to borrow for inventory. Let's say you want growth, you want to borrow some money for inventory. How can you borrow from yourself? I mean, can you explain that a little bit?
Sure. So once you've made the decision that you are going to start storing your capital inside a life insurance policy, which, by the way, these are whole life insurance policies with mutual insurance companies, and they're participating, meaning they pay dividends.
Mm-hmm.
Once you have decided to store your capital there, then with that contract, that's a contract between you and that insurance company.
Yep.
It's a private contract between you and that insurance company. And in that contract, there's a provision, a loan provision. And that enables you as a policy owner, and because it's a mutual insurance company, as an owner of that mutual insurance company, you have the contractual right to policy loans from the insurance company. So when you're using that loan provision, you're not withdrawing your own cash. Even better, your cash value stays in the policy. Your cash value continues to grow tax-free, uninterrupted, right? Supporting a death benefit and any of the other benefits of the contract. While you take a policy loan from the insurance company is using your cash value as leverage, as collateral on the policy loan. Okay. Right. And so because of that, it's one of the safest places that the insurance company can invest its money, because you've already capitalized the policy. The money is already in the policy backing it up.
Yeah.
And so the insurance company knows that they're going to make the policy loan to you. Yeah. The cash is there to back it up. So it's the safest loan that they can make.
That's great.
And so then now you have your money that you put into the policy first, supporting all of that and growing.
Yep.
And you have a policy loan for that value that you can use for whatever you need to use it for. And you mentioned inventories on those lean months. Maybe it's payroll. Maybe you have, people on the team that are relying on you, and you have a very low income month, we still want to pay those teammates, right? So the sky's the limit. You can use the policy loan for whatever you want to. There's no underwriting, no questions asked. You just tell the bank where you want the money to, you tell the life insurance company where you want the money deposited, and then you use the money however you see fit.
That's great. And for people who are independent thinkers, independent business owners, the first word is independent, and not having to, qualify or beg someone or fill out an application. You just call the company. I've used this a couple of times with ours, and when you need the money and the money is there, that's good. And it's not asking for permission when you need that. It's a really good thing.
100%. It's powerful. And I'm a real estate investor. Yes. And another powerful strategy is to use policy loans to then invest in real estate.
Yes.
And a lot of folks that enjoy real estate investing, they really get it when I compare the whole life insurance asset, the contract, right, to a home and the equity that's building up in the home. And so, the equity in your house, the difference between what's still owed of the mortgage and the market value, right, is building over time.
Yes.
And if you wanted to leverage that value that's in the house, you would go to the bank or some other lender, and you would go through their underwriting process. You would apply, and then hopefully you could either refinance or take out a home equity line of credit or something where they're going to loan you money and the equity in the home is what's backing it up.
Right.
So it's very easy to understand.
Yes.
The whole life insurance contract is very similar. The cash value, you could think of that as the equity. The policy loan would be comparable to a home equity line of credit. The major difference, though, and you mentioned it, is the independence aspect of it, the autonomy of it, the ease with which you can access that capital, right? That equity in the home, you're going to jump through some hoops to get at that. When times are great, income's flowing, we're not in a recession, then it might be easier to get at that home equity line than in other times. But there'll be times like in 2008 when folks tried to access the equity in their homes and they couldn't, because maybe they lost their jobs or the banks were tightening up because of the market conditions. And so all of a sudden they own this house and they have all this equity. They thought they had all this equity and they couldn't tap into it.
Yes. And
that's a major difference when it comes to the policy loan feature in whole life insurance. It's incredibly flexible. It's incredibly valuable to actually have access to the value in your policy contract whenever you need it. And once it's established in that contract, it doesn't fluctuate with the market.
Right.
It never goes down. And it's incredibly powerful to meet your financing needs.
Absolutely. I've been excited about it from the first day I learned about it, and, just waited forever to get started. So, what's interesting is that people can get started really at any time, right? Like I've heard of people over 65 starting policies like this. How is that even possible? I mean, obviously we're not comparing this to term life insurance where it's just basically a death benefit that you're renting.
Yeah, absolutely. There's a big difference between whole life and term insurance, and there's a place potentially for both types of insurance in your life. Term insurance is the cheapest way to secure a given amount of death benefit.
Yes.
And a lot of times, especially if you're younger in your life, early on in your career, and even if you want to start building this alternate source of financing with whole life insurance, you still might not have enough death benefit in that policy at first in order to meet the immense expenses and the loss of income, really, if something were to happen to you, to be able to replace that income for your family. A lot of times your initial whole life policy might not have the amount of death benefit that you want in place for your family. And so convertible term insurance is a very cheap way to add more death benefit for a cheaper premium, so that you can get the death benefit level up. But what we're talking about with the financing solution, this infinite banking strategy, is you can't do that with term because there is no cash value that's being built up.
Right.
So you mentioned 65-year-old. Yes,
Yeah.
a 65-year-old could, as long here's the limiting factor. The life insurance companies, there'll come a point when you reach a certain age that the life insurance companies may not issue life insurance anymore, but that I can tell you that that's well beyond 65 years old. And the reason that they can still offer life insurance to somebody who might be in their 60s and 70s is because of the way whole life insurance is designed.
Okay.
Whole life insurance is designed so that the premiums you're paying are basically the present actuarial value of what that death benefit is. And so the actuaries are kind of like engineers in the life insurance world.
Right.
They're taking in all the statistics, the mortality statistics, and they are telling the life insurance company, hey, for this person, this age, male, female, taking into consideration all the health concerns there may or may not be, hey, this is the premium that you should charge from now moving forward in order to secure that death benefit that they're looking for.
Right.
And the way whole life is designed then is that over the life of that policy, and I'm just talking about an ordinary base whole life policy right now, over the life of that policy, the cash value is guaranteed to grow to equal the death benefit by the time that policy matures, which in most policies today is age 121. It used to be age 100. But just as time has gone by, life expectancies have increased. And so now most ordinary policies, they'll mature at age 121. And at that time, that death benefit and cash value equal. And if you're still alive at that age of 121, the life insurance company would cut you a check for the death benefit, even though you're still alive. And so that is just basic whole life, how it works. And so, maybe you're older and further along in life, but the life insurance company can design a policy where your premiums you're paying into this policy, and the cash value will grow to equal the death benefit by the time the policy matures.
That's cool.
Yeah.
Oh, that's awesome. Okay. Now I do want to back up for a second, because when you were comparing, say, borrowing the equity in your home versus borrowing the word I'm forgetting, borrowing from
taking a policy loan and borrowing
right
against the cash value. You're not borrowing your cash value.
Right. Yeah, it's true. Leaving that alone, that's the value. But when you borrow against the equity in your home, that's risky. That there might not be people who have stomach for that kind of risk.
Right. So that's another key difference in a policy loan from the life insurance company and a home equity line.
Yeah.
So a home equity line of credit, the lender or the bank still has a lien on the home.
Yes.
So if the specified terms of the loan agreement aren't met, meaning whether or not you're supposed to pay interest only, or whether or not the loan's amortized and you have payments to make every month, if you're not meeting those terms, then there's a lien on your house. And so you're at risk of losing the house.
That's right.
With the policy loan, there's no lien on any of your assets other than the cash value in the policy is collateral on the loan. So meaning if one of two things happens, you happen to pass away with the loan outstanding, then out of the death benefit, the life insurance company would take whatever outstanding loan balance was owed to them, they would take that out of the death benefit. And so then the net death benefit would pass to your beneficiaries.
Great.
But had you taken that policy loan and you used it for a real estate investment, which I do a lot. If you used it for a car, if you used it for anything else, there is no lien on that. You own whatever that other asset you purchased was, you own that outright. There is no lien from the life insurance company on that asset. And so that's a huge, huge difference, because we go back to the small business owner, and let's say you took a policy loan and you bought a truck for your business, for
Mhm.
example,
Mhm.
and you bought it and your business is going well. All of a sudden you have a lean month
Yep.
and you can't make a policy loan payment.
Mhm.
Let's say you determined, that's another key feature of the policy loan, right? You determine the
Yes.
payback. But let's say that you decided you were going to pay back whatever you would have been paying to the finance company, the bank. You're paying that back to your policy loan. But
Mhm.
then 1 month happens and revenues are thin.
Right.
You can't make that payment. No harm, no foul.
Right.
Nobody's going to come take your truck.
That's
There
right.
is no lien on that truck. You own it outright.
Yep.
And we get to that other feature of a policy loan from the life insurance company, which is the life insurance company is not going to give you payback terms. Interest will accrue on the loan. And
Mhm.
so it's prudent for you to have a payback strategy, but you control what that strategy is. You
Yes.
control those terms.
Yep.
And therefore, you can match it to whatever investment strategy you have, to
Mhm.
whatever financing strategy you have in
Yep.
the example of the truck. Maybe you are paying it back monthly like you would have to a bank. The
Mhm.
key is though, you determine that.
Ultimate in independence.
Yeah.
Ultimate. It's
Yeah.
it's really good. Well, good. So, if people want to talk to you about the strategy, if there's how can people get a hold of you to talk about this? Because I know that you do business nationally. Um, this is not just for people like you and me who live here in Florida, but like anywhere in the US. How do people find you so that they can learn how to do this sort of infinite banking method for themselves?
Well, I am most active these days on LinkedIn. So if you just go on LinkedIn and you search for Brandon Jenkins, and you'll see my smiling face there.
Yeah,
Take a look at my profile, and if it looks like I'm providing content and information that's valuable to you, then ask for a connection. Let me know that you heard me on this podcast, or
absolutely.
just click the follow button and get an idea of kind of the information that I like to share on that platform. You can
Super.
also reach me at Brandon at tier1lifeinsurance.com. It's my email. And then my website's tier1lifeinsurance.com.
Beautiful. That's great. This is a quick conversation, but anybody listening, if you caught the bug that I caught when I first heard about this, get a hold of Brandon and talk about this, because this is really a magical way of handling, investment, um, financing, and life insurance. It just happens to be a nice benefit of the thing. So, Brandon, thank you so much for coming on today and sharing your ideas with everybody.
Thank you, Amy. Again, I really appreciate you inviting me on.
Super. You've been listening to the Traffic Handler Podcast. We're about getting new customers, making more sales, and growing your e-commerce retail business. I'm your host, Amy Biddle. Get more at amybiddle.me. And until next time, go sell more stuff.